Texas's legendary housing boom is showing dangerous cracks in its foundation, and the warning signs are becoming impossible to ignore. In these 10 cities, a perfect storm of rising interest rates, overvalued properties, and shifting demographics could trigger a significant market correction in 2025, potentially wiping out billions in home equity. Welcome back, everyone. Today, we're taking you deep into the heart of Texas's real estate market, where an unprecedented boom might be setting the stage for a significant correction that many industry experts are now beginning to forecast. The Texas success story has been remarkable. Median home prices soaring 71% between 2017 and 2023, population growth exceeding 15% between 2010 and 2020, and more than 50 major corporations relocating to the state since 2020. Tesla, Oracle, and HP Enterprise led the charge, bringing thousands of high-paying jobs and driving housing demand to historic levels. But beneath this veneer of unstoppable growth, market indicators are flashing warning signs that deserve our careful attention. Let's begin our journey in Austin, the crown jewel of Texas's tech transformation. Currently sitting at a median home price of $567,000, Austin's market has already begun showing signs of strain, with prices declining 5.2% over the past year. This isn't just a minor correction. We're seeing fundamental shifts in market dynamics. Tech sector layoffs have impacted over 23,000 Austin area workers since 2023. And the ripple effects are becoming apparent in the housing market. A staggering 47% of recent buyers are now considered house poor, spending more than 33% of their monthly income on housing costs. The city's skyline tells the story of potential oversupply. New inventory has surged 89% from 2022 levels, with 18,500 new units under construction. Even more telling, investor-owned properties now make up 36% of recent sales, creating a potentially volatile situation if these investors decide to exit the market simultaneously. Moving north to Frisco, we find an equally concerning situation in one of Dallas's most prestigious suburbs. With a median home price of $689,000, Frisco exemplifies the luxury market's vulnerabilities. Price appreciation has dramatically slowed from 24% to just 3.8% in 2023, while new construction permits have exploded by 156% since 2021. Adding 12,300 new units to the pipeline. The most alarming statistic? 42% of mortgages originated in 2022 and 23 are adjustable rate, with initial rate periods ending in 2025-26. With current rates above 7%, these homeowners could face monthly payment increases of $800 to $1,200, potentially forcing many to sell in a softening market. Property tax assessments have increased by an average of 28% in the past 2 years, adding another layer of financial pressures to homeowners. New Braunfels presents a fascinating case study in how rapid growth can overwhelm a market's fundamentals. This historic German settlement between San Antonio and Austin has seen its population explode by 56.5% since 2010, pushing the median home price to $378,000. But here's what makes this market particularly vulnerable. Infrastructure spending has lagged population growth by nearly 40%, creating bottlenecks that are beginning to impact property values. The city's water and sewage systems are operating at 92% capacity, and school districts are overcrowded, with student-to-teacher ratios exceeding state guidelines by 23%. With investor ownership reaching 41% of properties and inventory up 62% since 2022, the rental market shows clear signs of saturation. Vacancy rates have climbed from 4.8% to 7.2% in just 18 months. Round Rock's story perfectly illustrates the challenges facing tech-dependent suburbs. While the median price of $452,000 might seem reasonable compared to nearby Austin, a deeper look reveals concerning trends. Days on market have tripled from 22 to 68, and 42% of listings have seen price reductions averaging $27,000. Dell Technologies, the city's largest employer, has reduced its local workforce by 8% since 2022, highlighting the risks of over-reliance on a single corporate anchor. The city's high percentage of FHA loans at 38% of mortgages creates additional vulnerability. These buyers typically have lower down payments and less equity buffer against market downturns. patterns. New construction has outpaced absorption, with 3,200 units in the pipeline and another 2,800 in the planning stages. School enrollment growth has slowed from 6.8% annually to just 2.1%, suggesting changing demographic patterns that could impact future demand. Leander's transformation from rural outpost to major suburb tells an even more dramatic story. With a staggering 123% population growth since 2010 and a median home price of $425,000, this former small town has become a poster child for suburban explosion. However, the fundamentals raise serious concerns. A whopping 72% of residents commute to work elsewhere, with average commute times increasing from 32 to 47 minutes due to worsening traffic congestion. The city's property tax rate of 2.02% is among the highest in the region, and recent assessments have increased property tax bills by an average of 31%. Infrastructure struggles to keep pace. The city's water treatment capacity is at 87%, and road improvements are running 3 to 4 years behind population growth. First-time homebuyers account for 61% of recent purchases, with an average down payment of just 5.8%, creating significant exposure to market fluctuations. Please take a couple seconds to help me out and hit the like and subscribe if you find this video interesting so far. Each like and subscribe helps support this channel and keeps us motivated to keep making you great content. Thank you. Now let's continue. McKinney's market exemplifies the challenges facing Dallas's northern suburbs. The median home price of $495,000 has pushed the price-to-income ratio to 5.8, well above the 3.5 considered healthy. New construction is approaching concerning levels, with 4,800 units planned and another 3,200 in various stages of approval. The city's rapid growth has led to infrastructure strain. Schools are at 112% capacity, and traffic congestion has increased by 47% since 2020. Commercial real estate vacancies have risen from 8 to 14%, potentially signaling weakening job market conditions. The high concentration of adjustable rate mortgages, 34% of recent originations, creates additional risk as these loans reset in a higher rate environment. Insurance costs have surged 42% since 2022 due to increased severe weather events, adding another layer of cost pressure to homeowners. Denton's position as a college town adds unique complexities to its market dynamics. With a median price of $386,000 and 45,000 plus students influencing the market, the city faces distinctive challenges. The rental market commands 48% of housing stock, making it particularly vulnerable to enrollment shifts at its two universities. New construction has surged 134% since 2021, adding 8,700 units to a market that historically absorbs 3,200 annually. Student housing occupancy rates have dropped from 96 to 88%, suggesting potential oversupply. The city's job market shows concerning trends. Non-education employment has grown just 1.2% annually since 2022, while housing stock has increased by 4.8%. Property tax delinquency rates have risen from 1.8% to 2.9%, potentially indicating financial stress among property owners. San Marcos reveals similar vulnerabilities, but with even higher stakes. Its median price of $329,000 might appear modest, but with 61% of housing dedicated to the rental market and 38,000 plus students driving demand, the market's stability hinges on factors beyond typical real estate fundamentals. Recent enrollment declines of 3.2% at Texas State University have already impacted the rental market, with vacancy rates climbing from 5.1 to 8.7%. The planned addition of 2,800 units to a market already showing signs of student housing oversupply raises serious concerns. Local employment growth has stagnated at 0.9% annually, while housing stock has grown by 5.3%. The city's floodplain revisions have placed 18% more properties in high-risk zones, affecting insurance costs and property values. Kyle's rapid transformation epitomizes the risks of suburban sprawl. Population growth of 86% since 2010 has pushed median prices to $342,000, but the market's foundation shows cracks. With 68% of residents commuting and limited local employment, just 0.4 jobs per household, the market depends heavily on Austin's economy. The high percentage of FHA and VA loans, accounting for 58% of recent mortgages, indicates potential vulnerability to market downturns. Infrastructure lags significantly. The city's main arterial roads operate at 147% of designed capacity during peak hours, and water system improvements require $287 million in upgrades. New home builders have begun offering incentives averaging $22,000, suggesting softening demand despite population growth. Pflugerville completes our analysis with equally concerning indicators. At a median price of $389,000 and days on market increasing 186% from 2022, the market shows clear signs of shifting dynamics. With 2,400 new units planned and another 1,800 in the approval process, supply could soon overwhelm demand. The city's commercial tax base has grown just 0.8% annually since 2021, forcing higher residential property tax rates to fund services. Recent corporate relocations have fallen 68% short of projected job creation targets, while housing starts assumed those higher employment numbers. Climate change models suggest 22% of properties could require flood insurance by 2026, potentially adding significant costs for homeowners. These local market conditions become even more concerning when viewed through the lens of broader economic trends. Interest rates near 7% have fundamentally altered market dynamics, with monthly payments jumping 45% from 2021 levels. The Texas Housing Affordability Index has fallen from 0.82 to 0.64, indicating declining purchasing power for median income households. Property tax rates averaging 1.81% rank 7th highest nationally, while insurance costs have surged 34% since 2022 due to extreme weather events and rising replacement costs. The state's population growth has moderated to 1.8% annually, down from 2.4% in 2021, suggesting potentially softer future demand. While these market conditions may seem daunting, historical data shows that real estate corrections create substantial opportunities for prepared investors. Looking at Texas's previous market corrections, 1988, 2001, and 2008, properties purchased during these periods averaged 15 to 20% higher returns over the subsequent decade compared to properties purchased during market peaks. Let's examine specific strategies for navigating the potential 2025 correction. Understanding historical patterns is crucial. During the 2008 correction, Texas markets proved more resilient than the national average, with price declines averaging 12% compared to the national drop of 27%. However, current market conditions suggest potentially deeper corrections in certain submarkets. Areas with high investor ownership and recent rapid price appreciation could see declines of 15 to 25%, while markets with stronger local employment and limited new construction might experience modest adjustments of 5 to 10%. Demographic trends will play a crucial role in market recovery. Texas continues to attract roughly 1,000 new residents daily, though this represents a 28% decrease from 2021 peaks. Migration patterns have shifted. 42% of new residents now choose smaller markets over major metros, compared to 27% in 2020. This trend suggests opportunities in secondary markets with strong fundamentals and limited new supply. Climate change considerations are increasingly affecting investment decisions. Updated FEMA flood maps will place an additional 134,000 Texas properties in high-risk zones by 2026, potentially increasing insurance costs by 45 to 180%. Markets with robust flood mitigation infrastructure and properties in elevated areas may command premium valuations, creating opportunities for informed investors. For potential home buyers, timing and location become critical factors. Markets showing early signs of correction may offer opportunities by mid-2025. Key indicators to watch include price reductions. When 30% or more of listings show price cuts averaging 8% or higher, markets typically approach bottom within 4 to 6 months. Days on market. Historical data shows that when average days on market triple from cycle lows, prices typically adjust another 8 to 12% before finding support. New construction absorption. Markets where new home inventory exceeds 8 months of supply historically experience price declines of 12 to 18% before reaching equilibrium. Mortgage rate spreads. When the spread between conventional and FHA rates exceed 0.75%, it often signals reduced competition and better negotiating positions for qualified buyers. For investors, successful strategies will require careful market selection and risk management. Focus on markets with diverse employment bases. Areas where no single employer accounts for more than 15% of local jobs have historically shown 32% less price volatility during corrections. Target submarkets with limited new construction pipelines. Areas where planned units represent less than 4% of existing stock have maintained stronger price stability. Consider school district performance. Properties in districts with above-average test scores and stable enrollment have historically retained 12 to 18% more value during market corrections. Evaluate infrastructure investment. Markets with funded infrastructure improvements typically recover 40% faster from downturns. Historical analysis of Texas real estate cycles reveals distinct recovery patterns. The primary markets of Dallas, Houston, Austin, and San Antonio typically lead recovery cycles, with price appreciation beginning 3 to 6 months before secondary markets. However, the current cycle shows unique characteristics. Remote work has disrupted traditional commuting patterns, with 38% of Texas workers now primarily working from home. The shift has reduced the historical price premium for close-in suburbs by an average of 12%. Corporate relocations have evolved. While headline numbers remain strong, actual job creation is running 34% below projections, potentially impacting future housing demand. Supply chain normalization has accelerated new construction completion rates, potentially extending the time needed for inventory absorption. Climate migration is emerging as a significant factor, with 23% out-of-state buyers citing climate concerns in their decision to choose Texas, despite increasing local severe weather events. Key economic indicators will signal market transitions. Texas' leading economic index. Historically, housing markets begin recovery 4 to 6 months after the index shows 3 consecutive monthly gains. Corporate relocation announcements. Current data shows a 47% decrease in announced relocations compared to 2022, suggesting softening future demand. Building permit trends. Markets where permit applications drop below the 24-month moving average typically approach price stabilization within 2 to 3 quarters. Employment diversity metrics. Areas with Herfindahl index scores below 0.12 have historically shown 28% less price volatility during corrections. The potential 2025 correction in these Texas markets presents both challenges and opportunities. Success will require careful analysis, strategic timing, and thorough due diligence. Historical patterns suggest that well-positioned investors who enter correcting markets with strong fundamentals often achieve superior long-term returns. Subscribe for weekly market analysis updates and detailed reports on the economy, and watch this video as well.